Imagine doing the absolute hardest work of your life today.
Right.
You save a patient.
Yeah.
You provide incredible care. You bill $1,500 for the procedure.
Yeah.
Then you wait half a year to actually see a single dime.
It is so frustrating.
Meanwhile, your clinic's payroll is staring you right in the face. It is due this Friday. Your staff needs to feed their families.
This is the exact nightmare keeping independent doctors awake at night.
It really is.
Yeah.
Today, we walk through the approval playbook for healthcare owners. You are stuck between a 60 to 180-day reimbursement cycle and a looming payroll due on Friday.
Exactly.
I want you to run the healthcare reimbursement gap calculator right now. You can find it at BusinessLoan.Directory before you keep listening.
Yeah, that calculator is completely essential for your survival plan.
It tells you exactly which step of the bridge-then-takeout playbook your numbers support.
Which is so important.
Our previous deep dive covered the gap math. We talked about how much money you lose while waiting. Well, this current deep dive covers the approval math. We're talking about how you actually get the money.
Most healthcare owners walk right into a massive trap here.
Oh, wow, really?
Yeah, they panic. They try one single capital move, like they just apply for a random loan.
Right?
They either get approved and celebrate, or they get crushed and close their doors.
That sounds terrifying.
It is.
Yeah.
Single product thinking is a complete mistake in this industry.
Wait, I am confused. How can a single loan be a mistake, especially if it successfully covers your immediate payroll? Is that not the entire goal?
Well, I mean, you are treating a complex disease with just one pill. You are treating a chronic cash flow problem with a one-time Band-Aid.
Ah, I see.
The true playbook requires two distinct steps. You bridge with AR financing right now.
Okay.
Then you take out with an SBA 7 loan at year 10.
So it is a two-part move.
Exactly. That specific refinance saves owner-operators over $200,000 in interest.
That is a massive amount of money. I see the strategy now. You need immediate triage today just to survive the week.
Right.
And then you need long-term rehab to actually build wealth over the next decade.
Survival always comes first. To reach that year 10 takeout, you absolutely must survive year 1.
Makes sense.
That means bridging the immediate cash flow gap today. So, let us look at the mechanics of AR financing.
Well, I am stuck on the approval process. My personal credit is completely shot right now.
Here.
I maxed out my personal credit cards just to float payroll last month. How is any commercial bank going to advance me hundreds of thousands of dollars?
Well, because the AR factoring lender is not really looking at you.
Wait, they are not?
No, they underwrite your payer's credit instead of your personal credit. This is a vital distinction.
So they're looking at Medicare or major commercial insurance providers instead.
Exactly.
They know the United States government is always good for the money eventually.
They absolutely do. Your personal FICO score becomes secondary to the payer's financial strength.
That changes everything.
It really does. The lender advances you 85 to 95% of those locked invoices.
Okay, what does it cost?
The fee generally sits around 2.5% to 4.5%.
That is not bad.
And best of all, you get same-day funding.
Wow, same day. That same-day funding actually solves the Friday payroll panic. I can finally breathe again.
Yes, exactly.
But what exactly do I need to provide? Like, how do I prove those claims exist?
You need an aging AR report first.
Okay.
This document proves exactly who owes you money. It also shows how many days late they are.
Right.
It usually categorizes your invoices into 30, 60, and 90-day buckets.
Well, that makes perfect sense. Lenders need to see the timeline of your delayed cash.
Yeah, they do. You also need a detailed payer mix breakdown.
What does that show them?
This shows the lender exactly where the funds originate. They need to know the split between Medicare, Medicaid, and private insurance.
I see. Lenders clearly want to evaluate the risk profile of the institutions paying you.
Exactly right. You also need to provide 3 months of standard bank statements. And a raw billing software export is required too.
Got it.
But I want to revisit your concern about credit scores.
Yeah, please. The maxed out credit cards are a huge source of anxiety for many clinical directors.
I completely get it. A sub-680 FICO score does not disqualify you from this specific product.
That is a relief.
The factoring lender focuses entirely on the payer's ability to clear the invoice.
I have to ask about highly regulated fields, though. What about substance use disorder clinics and behavioral health facilities?
Sure.
Are strict privacy laws a roadblock for this specific funding?
Well, privacy laws historically blocked behavioral health clinics from using AR financing entirely.
Really?
Yes. Sharing sensitive patient data with a third-party lender violated strict federal rules.
Oh, you were talking about a federal regulations covering substance use disorder records.
Yeah, I'm talking about 42 CFR Part 2. It was a massive headache.
I bet.
But you need to look at the massive 2024 regulatory update. It aligned those strict behavioral health records perfectly with standard high-power rules.
Oh, wow. Explain how that legislative change alters the game for clinic owners.
It changes everything. One single TPO consent form now covers everything.
Just one form.
Just one. Patients sign one standard form for treatment, payment, and healthcare operations.
So you do not need multiple redundant privacy forms just to prove an invoice is real to a bank.
Exactly.
That legal update unlocks the ability to finance those previously restricted receivables.
Yeah. Factoring lenders in this specialized space understand the math now.
Okay.
Your 60 to 180-day reimbursement cycle is completely priced into their risk models.
Right.
They fully expect standard claims of $800 to $1,800.
Well, the addiction treatment market is a massive $42 billion industry, so factoring companies finally built the financial technology to serve it.
Exactly. Factoring used to be a slow and manual nightmare. You had to fax papers.
Faxing is the worst.
It really is. Modern browser-native technology verifies these healthcare claims in seconds now.
That is amazing. But, some traditional clinic owners might hesitate to factor their invoices. They might want a different structure entirely. What happens if they want an alternative way to bridge the cash flow gap?
Well, a working capital line of credit is your main alternative bridge product.
Okay. Limits generally range from $10,000 to $500,000, right?
Yes, that is correct.
But the requirements are definitely stricter here. You need a solid 600 FICO score minimum.
You do?
And you also need 6 months of proven time in business.
Yeah, the mechanical structure is very different from AR financing. A line of credit is revolving.
Right.
You pay interest only on what you actually draw down into your checking account.
So it acts like a proactive safety net for unexpected reimbursement delays.
Exactly.
You just keep it open just in case Medicare payment algorithms glitch.
Yeah, it works brilliantly if your revenue cycle is highly predictable.
But what if it is not?
Well, for pure speed to solve a sudden Friday payroll crisis, AR financing is usually better.
I mean, that makes total sense. So AR financing keeps the lights on today, but paying a percentage fee on every single invoice is not a long-term wealth strategy.
No, it is definitely not.
You eventually need cheap fixed capital.
Yeah, and that brings us to the second crucial step of the playbook.
Okay.
Year 10 is the designated takeout window. This is when you refinance your expensive bridge debt into an SBA loan.
That makes sense. Variable SBA rates currently set at 7.5% to 9% in the open market.
Right.
And conventional fixed rates are hovering around 5% to 6%.
Securing a fixed rate brings enormous payment stability to your growing practice.
So what are the specific underwriting metrics for that year 10 takeout?
Well, your DSCR must sit above 1.25. You need a solid 680 FICO score.
Okay.
And 2 years of clean operating history is the absolute minimum requirement.
I know most conservative banks highly prefer 10 full years of operating history.
Yeah.
But I want to break down that DSCR requirement.
Sure.
It just sounds like financial jargon.
I get that. Debt service coverage ratio is the single most important metric for any commercial underwriter.
Break it down mechanically for me. What does a 1.25 DSCR actually look like for my neighborhood clinic?
Okay, the SBA does not care about your impressive gross revenue numbers. They only care about actual cash flow.
Right.
A 1.25 DSCR means your business generates $1.25 in verified profit.
Okay.
It generates that for every single dollar of debt obligation you have.
Got it. So if my new monthly SBA loan payment is $10,000,
Yes.
I need $12,500 in net operating income.
Exactly. You also need 3 full years of completely clean tax returns.
Which brings us to a massive trap most owners never hear about until it's too late.
Oh yeah, this is a big one.
I am talking about MCA debt. Taking a merchant cash advance to bridge payroll completely ruins you.
It really does. As of June 2025, the SBA cannot refinance MCA debt at all.
Wow, really? Taking MCA to bridge your payroll is like swallowing poison to cure a simple headache?
That is a great analogy.
You successfully stop the pain today, but you structurally destroy your daily cash flow tomorrow with those aggressive daily bank deductions.
Exactly.
By the time the SBA looks at your business, they will not touch you. You literally block your own exit.
The SBA identified a terrifying vicious cycle with merchant cash advances. Clinic owners would take a high-interest MCA out of pure desperation.
Right.
Then they needed another one just to cover the daily payments of the first one.
Oh, wow. A death spiral?
Yes. Default rates spiked across the entire medical industry.
So the SBA simply stopped bailing out MCA debt entirely to protect their own portfolio.
They completely closed the door, but there is another hidden trap here regarding your long-term tax strategy.
What is it?
Well, the SBA wants 3 years of highly profitable tax returns.
Right. But your short-term bridge product only asks for 1 year of returns.
Exactly. You must plan your financial runway carefully. Your aggressive tax strategy now literally becomes your loan approval strategy later.
Explain the mechanical conflict there. I mean, the conflict between minimizing your taxes and getting a commercial bank loan. Why is this such a big problem for doctors?
Because medical practices love utilizing the Section 179 tax deduction.
Oh, I heard of that.
Yeah, it allows you to write off millions of dollars in new medical equipment purchases immediately.
Right.
This massively lowers your tax burden for the current calendar year.
So buying a $200,000 diagnostic machine saves you serious money on taxes today.
It does.
But it makes your thriving clinic look completely broke on paper.
Exactly. The mechanical calculation of paper depreciation makes a cash-rich business look incredibly poor to an SBA underwriter.
Wow.
You might save $40,000 in taxes this year, but you just ruined your DSCR calculation for a future SBA loan.
That is wild. You cannot look broke to the IRS and rich to the commercial bank. The math simply does not work.
It really does not. You have to coordinate your moves with a specialized healthcare CPA. You need to show steady and profitable growth leading up to that year 10 window.
Coordinating all of this sounds like a total logistical nightmare. I mean, you need an AR factoring company now.
Yeah.
And then you need an SBA lender a whole decade later.
It is a massive headache if you use disconnected lending platforms.
Which is exactly why you use BusinessLoan.Directory.
Yeah.
BusinessLoan.Directory's 75-plus lender marketplace runs both of these exact products.
Right. You find AR bridge specialists and SBA takeout specialists in the exact same place.
You do not switch platforms when you graduate to the next financial level.
Yeah.
You build a banking relationship that scales up with your practice over time.
Exactly. So let us zoom out and look at why this specific playbook is so vital right now.
Okay, why?
Because massive corporate predators are actively circling your independent practice.
I read about this. Independent practice ownership dropped from 75% in the 1980s to 33% in 2024.
Yeah, it is awful.
That is a staggering collapse of private medicine.
Well, operating costs consistently outpace standard inflation. And crushing administrative burdens break independent doctors down over time.
Oh, for sure.
Yeah.
Doctors currently spend 2 hours on data entry and tedious paperwork for every single hour of actual patient care.
Right. The medical industry calls it pajama time.
Pajama time.
Yeah, exhausted doctors sit at home doing data entry late at night in their pajamas.
That's so sad.
It drives an insane 42% burnout rate across the profession.
And the massive healthcare corporations use this exact exhaustion against you. They leverage your burnout to steal your practice equity.
Exactly. The largest insurance payers intentionally sit on your receivables. They hold your earned money hostage.
Just to squeeze you.
Yes.
I need to understand the dark mechanics of this squeeze. How does holding my money turn into a ruthless acquisition strategy for them?
Well, the big corporate payers choke your daily cash flow first.
Okay.
Then they conveniently offer fire sale loans to independent practices that cannot bridge the manufactured gap.
Oh, wow. That is so predatory.
It is.
We saw this exact tactic during the recent massive healthcare data hacks. The big corporate entities offered emergency loans to desperate clinics, but they demanded incredibly rapid repayment schedules.
Right. And when the independent practice could not pay those aggressive terms, they defaulted.
And now what?
Then they got acquired by the lender for absolute pennies on the dollar.
This is exactly like a commercial landlord raising your rent astronomically. Then they swoop in to buy your failing business for dirt cheap when you inevitably miss a payment.
It is a highly calculated financial squeeze play.
It is brilliant, but evil.
The massive entities control your reimbursement timeline. Therefore, they control your access to capital.
So smart owner-operators use independent AR financing to stay alive. They build the financial defense system.
Yes, they completely refuse to become part of the Bank of Big Medicine. They utilize third-party capital to bridge the gap on their own terms.
I mean, if you let the payer become your primary lender, you lose all of your leverage. You basically hand them the keys to your entire business.
You quickly become an exhausted employee in the very clinic you built from scratch.
That is terrifying.
Mm-hmm.
Let us review the timeline for this entire strategy. We need to lock in the sequence so nobody forgets.
Okay, year one is all about survival. You aggressively bridge the cash gap.
Right.
You secure working capital in 24 hours. Your Friday payroll is fully funded.
So you survive the most dangerous part of the revenue cycle. You stay totally independent.
Exactly. Now fast forward to year 10. You completely refinance your expensive bridge debt with an SBA 7A loan.
Okay.
You lock in a low fixed rate for the long haul.
That specific financial move puts $200,000 back into your own pocket.
It does.
You have beautifully clean taxes and a rock-solid operating history. You become the prime owner-operator that every single bank competes for. You dictate all the terms.
Yes, you take back control. But I want to leave you with a terrifying thought about the future of this industry.
Oh boy, what is it?
What happens when massive payer algorithms start automatically denying your medical claims?
Wait, you mean using artificial intelligence to reject valid claims simply to squeeze your liquidity?
Yes. AI is already reading complex medical claim attachments. It actively searches for tiny technical reasons to deny your money.
That is scary.
They want to force you into their predatory corporate loan products.
So the real question is your current billing software smart enough to fight back against a billion-dollar algorithm?
Exactly. The war is permanently shifting from pure medical expertise to financial technology.
Wow.
If you do not have independent liquidity, you simply cannot fight back against the machines.
You need your own financial war chest to survive this coming battle.
You really do. Run the Healthcare Reimbursement Gap Calculator at BusinessLoan.Directory.
Yeah, the bridge-then-takeout flag on that calculator tells you instantly if your current numbers support the playbook.
Pre-qualify when you are ready.
Yeah.
Right capital at the right time.